Okay, I'm going to go over how to calculate something called the payback period and also the discounted payback period. So let me just go ahead and get right into this. Let's read the problem first, I guess. This is basically a capital budgeting problem. So it's saying you're investing $270,000, and let me just do a. I draw this just to save time. I'm going to put this right here for you. Oops, hold on. I'm going to put this in here to save a little bit of time. Put a little drawing in here for you. So this is basically what's happening, right? You're investing $270,000, and then you're receiving from this investment. You're receiving these cash flows in the future. Year 1, 2, 3, 4, and 5 years. You're going to receive these cash flows, and it costs you 11% to borrow this money. Okay, so the question is, how long does it take to pay this back? And you're going to use two methods: discounted payback and a payback period. So we're going to do first. We're going to go over the payback period, and that's the simplest form of capital budgeting. And you basically need zero knowledge of finance in order to solve this. So let's just go ahead and put it in here. We'll put it in here as a table first. So we'll say year and cash flow. And we'll start with year 0 because their initial investment is at the end of year 0 or the beginning of year 1, right? And I'm going to go 1. I'm sorry. You go 0, 1, and then if you drag, it'll get the idea. And I'm just going to take these cash flows. I'm going to copy them here just to save time and a paste of transpose. Okay, so this is what we're given, right? And if you double click, that auto fits the width of that. And we want to find the payback period and purchase project. I just say purchase just to be save some. You guys understand? Should the project be purchased? And also we want to find the discounted payback period, and also would we purchase it using that? So there, I mean, both of those are going to come to a conclusion, right? So then finally for a solution, what I could do, let me just go ahead and copy this information down for this first one. And copy it over. And we'll format this the same. The only thing is we want to do different. Let's go ahead and make this a negative 270,000 because it'll make more sense that way. So you're investing out of your pocket is coming 270. This arrow is pointing down over here, right? So we'll say 270,000 is coming out of your pocket, and then you're getting positive cash flows. And then what we can do, like I say, the payback period is very simple. You're just going to calculate the running balance. And so I'm going to start out with 270. So at the end of the year 1, how much do I have left? I paid back 75,000. How much am I going to have left? So this is going to be equal to a negative this plus what I got, the money I got back. So now I've gotten back 75,000. So my balance is 195,000. Now, the simple thing with Excel, I can just double click here and it sends it down and does the other ones. So I can equal formula text. Let me put the formula in here so you can see. Okay. So we can see we've paid back this 270,000 somewhere between the 3rd and the 4th year, right? Somewhere between here and here, we paid it back. So we know our payback is 3.3 years and some fraction. Well, the fraction is 45,000 over 75,000. I still haven't paid back 45,000, and in year 4, I'm going to get an additional 75,000. So the way I would calculate that is very simple. It'd just be equal to, well, my last negative year is this one right here. Plus, the only problem is this is negative, and I want it to be positive, so I'm going to go negative this to make it positive, divided by how much I'm getting in the next year. And of course, this isn't dollars anymore, so I'm going to click on this little comma here to make it a number. And we'll say years, right? So the payback period is 3.6 years. Now, Let me put the formula in here too. I'll put it over here. I'm going to drag this. So it's pointing to this. So it shows the formula on that. All right. So now the question is, do we want to purchase it? Well, sometimes when you're doing a capital budgeting project, they say the payback period has to be a certain number of years, right? In this case, they don't. So you would just use the life of the project as a maximum. If it doesn't pay it back by the time the project is over, well, then you would not purchase it. So if the payback period was 6 years, say, well, you wouldn't purchase the project. Now, I've worked for companies. I worked for a Fortune 500 company, and the plant that I worked at as a manager, the maximum payback period for them to adopt a project was 1 year, if you can believe it. So if you invest $270,000, it had to pay it back in the first year. So as you can imagine, we didn't buy a lot of equipment for that factory, right? So this actually gets used in real life. Okay. So anyway, so what I'm going to do is I'm going to purchase. I'm going to use something called an if statement just to show you can have Excel figure this out. So equals if whatever my payback statistics I calculated is less in this case than the life of the project, since they never gave us a specific criteria. And then if it's true, we would say yes, purchase it. If not, we'd say no. In this case, it'd be yes, purchase it, right? Okay, let me move this over here. Okay, so that just shows you how easy that is. Now, we can go ahead and do the other one now. So I'm going to go equals this and copy it down. Control Z is your friend here. I copied it wrong. So I want to go down to 5, copy it over. I'm going to copy these formats. I'm going to go format painter, that. And I'm going to auto fit that to get rid of those palms. Okay. So now we're going to do the second one. We're going to do the discounted payback period. So this one is actually pretty simple too, but what you have to do, you have to calculate something called the present value of these cash flows. So I'm going to just call it PV cash flows. Okay. And so to calculate the present value, I could use a Excel function called equals PV. So I'll just do it that way. You can also use there's other ways to do it, but I'll just use the Excel finance function. And this is very easy. First thing it asks for is a rate, right? Well, the rate is, we have it over here. I forgot to put it over here in the given, but we have it over here in our diagram. So I'm going to click on it right here. And I'm going to go F4. Now, F4 puts dollar signs there. You can type those dollar signs, or F4 is just a shortcut way to do it. And what it does, it makes it so when I copy this formula down, it doesn't move off that 11%. I don't want it to go down to here, down to here, down to here as I copy this formula down. So it makes this what's called an absolute reference. I'm going to hit comma, and the next thing it goes to the number of periods. Well, where I'm calculating this formula right now, here I want the present value of this one. Well, we're on period 0. And these aren't going to be considered payments. They're going to be considered future values. So I'm going to skip the payment. And you guys may notice that this is turning bold as I put the comma. It goes into each function argument. So if I'm skipping the payment, I could put 0, but I can, to save a little bit save a calorie, I guess we could say, I'm going to hit a comma. So I don't have to type that 0. And then my future value is this. And then I'm going to close the parentheses, and you're going to see something a little bit. What's going to happen here is going to not be what you expect. It's going to make it a negative. It's going to make it a positive 207. We want it to be negative. We want it to. So present value will flip the sign on you, okay, because it pays attention to cash flow directions. So we'll go ahead and put it in like that, right? So now if I drag, now of course the present value, it's already at the present value. You're already at 0, so it's exactly 207. Let me put the formula in here. But if I drag it down a year from now, well, $75,000 a year from now is only worth $67,567.57, right? Because if I invested this right now at 11%, that's what I would get a year. You can look at it both ways. So anyway, so if I drag this down, you go out further in the future, that's $75,000 worth less to me right now. In other words, you have to pay back the interest on this. So you have to find the present value of this. But anyway, so hopefully that makes sense. I don't know if I explained it well, but that's how you do it. Okay, and then we're going to do the same thing. We're going to calculate the balance. What we have to do is calculate the running balance again. So again, it's going to start out with this. And then the next year, now you're not going to add the 75,000. You're going to add the present value of the cash flow. So I'm going to go equals this plus this, right? I can drag that down. Let me put the formulas. Okay, so you can see this one took 3 years. Well, this one took 4 years and some fraction, didn't it? Because the last time it's negative is 4 year, and then it's positive, and by the time we hit the 5th year, it's positive. So, well, the fraction is going to be this divided by this. So I can calculate the discounted payback period. Well, it's equal to 4 years plus, again, I want that to be a positive, so I'm going to go negative this. The negative is a positive. Divided, not divided by 75,000, but divided by the present value of that cash flow. And again, we're gonna format that as years, right? So I'm going to move this over. I'm going to put years. Right, so that's a discounted payback period. And then we can go ahead and copy this formula. I'm going to copy this. The only thing we have to do, we have to make sure that this is going to be pointing to your 5, right? Is this less than 5 years? Yes, it is. Let me call this purchase. Okay, so that's it. That's all you have to do. Hopefully that makes sense. It's actually pretty easy to calculate, especially like I say, you need no knowledge of finance to do this, right? You're not using the interest rate. Here you are using the interest rate. You have to discount back these cash flows to time 0, right? Using this interest rate. All right, so that's it. If you like the video and want to subscribe to my channel, if you click on my picture, it'll come up. You can click on that. You can subscribe. Give me a thumbs up if you liked it. Give me comments. I like reading comments, whether you learned something, you thought it was interesting. That's it for today. Thanks for watching. Bye.